Literally everyone wants to know what their future is going to look like. And today I'm going to help you get your head around at least a part of that by showing you 3 different ways that you can figure out how much you are going to need to retire. My name is Reese, and I own an independent financial planning practice that specializes in exactly this, retirement planning. And I know a lot of people are looking for a quick answer, like you need $1 million to retire, or you need 1.2 to retire, or whatever the number is. But it simply doesn't work like that because we all have a different amount that we want or need. We all have different amounts coming from different sources, etc., etc. So we're all going to have a different answer to that question. And it takes a bit of legwork to get to that answer, but it's not hard. And I'm going to show you how to do it from 3 different angles. Manually, using free online calculators, and how we do it. And here's a big fat spoiler alert. How we do it is way better. And it's not that the first 2 methods can't work. They can work, especially in really simple situations, but they are ballparking. And there is no strategic game plan included for how to maximize your options, get way more out of what you have, and give way less to the government. But we do all of that, so yeah, naturally, it's going to be way better. It was a bit longer of a video because I wanted to be thorough and make sure that you were well equipped to be able to do all of this on your own if you want to. But that said, I've also taken the time to mark out the chapters below, and so if you want to skip ahead past a section that doesn't apply to you, or if you want to jump back and re-watch something that you found interesting, easy peasy. Now, before we get too far into this, you need to make sure you have some key details nailed down. The first one is, when are you going to retire? This one is super important because not only is it when you will stop earning money, unless you're semi-retiring or something like that, but it's also when you will start taking money out of all of the investment pools that you've been saving into along the way. Plus, it also usually heavily impacts when you're going to take certain pensions like CPP and OAS. And when you choose to take those can have a dramatic effect on the amount of income you will have throughout your retirement. But I discuss all of that in lots of other videos, so I'm not going to bog us down with it here. The next key detail is how long you think you're going to live. Or in other words, how long you will need retirement income for. Obviously, the shorter your life expectancy, the less money that you are going to need. And the longer you live, the more you will need. Now, it's pretty standard in our industry to plan to age 90, but that's just to be on the conservative side of things. Average life expectancy in Canada isn't actually that high. It's more around 83-ish at the moment, but it's forecasted to increase a bit over time. So if you're younger right now, you expect that number to tick up for you. Again, this is just an average. So if you want to get more serious about it, Sun Life actually has a pretty cool online tool that will give you an estimate of your life expectancy based on a bunch of variables that apply to you. And yeah, it's just an estimate, but these cats are in the business of doing these kinds of estimates all day long. So next, you need to figure out how much money you want or need each month in retirement. And lots of times when I ask people this question, they really struggle with it unless they are budgeters. People who live by a budget know exactly what they need every month, and they know right away what they can survive on in retirement. And hands down, doing a budget is going to be the best and most accurate way to figure this out, no doubt. But people who do not do budgets don't do budgets. And I know because I'm one of them. So for us cats, we have to estimate. And one of the most popular methods to do this is known as the 70% rule. Basically, you just take whatever your current income is and chop off 30% of it, and that's your estimated retirement income. So if you currently make 100 grand a year, simply lob off 30%, and that leaves you with a retirement income of $70,000 per year. Now, obviously, this is a super simplistic approach, but that's also probably why it's so popular. You see, the basic logic here is that when you retire, you're probably going to want the same basic standard of living that you had before you retired. But hopefully, when you're moving into retirement, you're going to have a number of expenses that you can trim or eliminate, such as mortgage payments, retirement savings, pension contributions. If you're a couple, you might even be able to go down to one vehicle, etc., etc. Of course, if for whatever reason you think 70% is too high or too low, well, then you can just jack it up or just drop it down. Another way to approach this would be to simply take your current expenses and just subtract any expenses that you don't expect to bring with you into retirement, like the list that we just went through. Again, this is just a way to estimate, but can actually do a pretty decent job. One problem with it, though, is that it doesn't take into account the different phases that we tend to go through in retirement. The go-go phase, the slow-go phase, and the no-go phase. Basically, we tend to party a little harder in the earlier years of retirement than we do in the later years of retirement, and partying harder just costs more. And in that last stretch of retirement, we tend to not really do a whole lot, and so therefore our costs go down quite a bit as well. Now, obviously, you could end up with some higher medical expenses, or if you have long-term care expenses, that can add up quite a bit. But I can tell you, having done this for a long time and worked through a number of situations with clients, what we really do see on the ground is that most people's expenses do tend to decrease as they get older. So if you do use the 70% rule, then it's likely that you will end up planning for more income than you will actually need, because you just probably won't spend that much money in your later years. But I'm a massive fan of having a solid buffer built into your retirement plan. So as far as I'm concerned, having a bit of extra money left over isn't really the worst thing that could happen to you. Okay, now the last key detail you need to nail down is your list of retirement income sources. Needless to say, you want to be thorough with this list. Most people will be going from a situation where they're used to getting paid from just one source, their employer, to going to a situation where they're getting paid a whole bunch of different amounts from a whole bunch of different sources. So you want to know what all of those are going to be in advance so you can clearly figure out how much will be coming from others paying you, and therefore how much will need to come out of your own investments to make up the difference. Now, the following is not an exhaustive list of all of the different sources of retirement income that you could have, but it's a pretty stinking good one. And you can simply pause on these screens and copy them down if you want to use them to build out a list of the sources that you might have. And believe me, it is possible to accidentally miss or forget about some of these, especially if you have accounts spread out all over the place. We see that all the time. And I actually just recently had a client reach out to me and let me know that she had a small pension that she'd forgotten about, and they were contacting her because she needed to make a decision about how to start taking the income. Turns out it was another $600 a month. So that was $600 a month, or $7,200 a year, that she no longer needed to pull from her own investments. And needless to say, over time, that's a big deal. Anyway, there's lots to say about each of these sources of income, but that's not the focus of this video. But what I will say is that each of these sources have their own features, and they all have an impact on your situation. Some are indexed to grow with the cost of living, some are taxed better than others, some are taxed worse. Some will pay more or less depending on when you take them, etc., etc. So while knowing what you have is very important, knowing how they integrate and when to take what and how much is a whole different animal. And you can ballpark and estimate these things, absolutely. But as you will see later in the video, doing it the way we do it, by using the best tools in the business, you can eliminate all the guesswork and the mistakes, and you can save a ton of money. Okay, we're there. You've done the groundwork, and now we're ready to find out how much of your own money you are going to need. And as promised, I'm going to show you how to solve this from 3 different angles so that you'll be fully armed to do it whatever way you like. The first method is the most painful of the 3, manual. It's painful because you have to do the math, but it's easy because the math is really easy. Let me show you using a really straightforward example. Let's say you're single, retiring at 65, and you're going to live until you're 90. So that's 25 years of retirement income that you'll need. And for those 25 years, you'd like 60 grand of income each year, which is 5 grand a month. Let's say the only sources of income that you'll have are CPP, OAS, and your own investments, an RRSP and a TFSA. You also own a house worth $1 million, but we're just going to leave that alone as a backup asset in case you end up needing long-term care or something like that. Anyway, you're expecting 2 grand a month from CPP and OAS combined. So that just leaves 3 grand a month, or 36 grand a year, that you'll need to come up with on your own. The first way to solve this is simply by multiplying the 36 grand by the number of years you will be retired, which in this case will be 25. There you have it, 900 grand. That is your ballpark number. This little trick is known as the 25 times rule, and it's a rule because it's a pretty standard number of years to plan for. But obviously, you can just increase or decrease the number of years to tickle your fancy. Now, obviously, we always have to consider inflation because it simply is not going anywhere anytime soon. But to pretty much mitigate it, all you need to do is make sure that your investments are in something that's reasonably intelligent, a reasonably diversified portfolio that at least has the chance or the opportunity to keep up with or outpace inflation. But more videos to come on that later. Another way to get to the same spot is what is known as the 4% rule. The basic idea here is that if you have a balanced investment portfolio, then you can safely withdraw 4% of it in the first year and then increase your withdrawals by the percent of inflation each year. And if all goes relatively well, your portfolio should be able to safely last you 30 years or so. So with our example, if we know you need $36,000 of your own money in your first year of retirement, all we need to do is figure out what $36,000 is 4% of. And rather than drown you in math, I'll just show you the formula here and just tell you that the magic number is 900 grand. So according to this method, you need an investment portfolio of $900,000 to get you what you want, which, if you recall, was the exact same number we came up with when we used the 25 times rule. But the 25 times rule was way easier. Now, there are other ways to manually estimate how much you're going to need, but we don't want to be here all day, and none of them are foolproof anyway. They're all just estimates, and they all have their flaws. And since the advent of software, pretty much no one uses manual calculations anymore anyway. Which brings us to the second way to figure out how much you'll need, using free online calculators. Now, these can be super quick and super easy to use, and some can actually be pretty decent, but it is wise to remember that they are still just estimates. Now, I've taken the time to search out and work through a whole bunch of these, and some are way better than others, and some, frankly, are garbage. So what I'm going to do is run you through the one I liked best, and I'll also point out a couple of honorable mentions. And I'll post links to these and a few others down below in the description, because if you are going to use these, definitely the more estimates that you have, the better. And remember, these tools can change at any time, right? These are just free online calculators, so they can update them, eliminate them, bring in newer, better ones, whatever. But as of now, my favorite one is Desjardins. It's not the flashiest, but it's pretty detailed and it is super easy to use. You just plug in your basic details and hilariously, like our federal government, it appears Desjardins also thinks Canada is made up of only Ontario and Quebec. But just choose Ontario if you live anywhere other than Quebec. In the interest of time, I'm just going to use all the same assumptions we did before, and I'm going to assume the same $900,000 investment portfolio that we came up with using the manual methods. Let's say 750,000 of that is in an RRSP and the rest, 150,000, is in a TFSA. Now, according to this software, we're going to end up with some excess. And this is very helpful to know because maybe once you know that, you're going to want to tweak it and see if you could spend a bit more each month, or maybe save a bit less, or retire a bit earlier. I also really appreciate how this shows you where your portfolio is estimated to be at year after year. It also shows you a breakdown of where your income will be coming from each year. In this case, it's just CPP, OAS, and the personal investments. But in your case, in your real case, it may be way more complex, and it's just nice to be able to see it visually like this. Lastly, it allows you to compare it with another scenario in case you want to tweak your numbers a bit and just see how they'd match up. Again, this is just estimating, but it's free and it's decent. The other two online calculators I recommend you check out are CRAs and Empire Life's. The reason I recommend CRAs is because it's probably going to be the most thorough of the free options, and of course, it has some level of credibility behind it simply because the government is posting it right on their website. Will it be as frustrating as every other interaction you have with CRA? I don't know. I haven't done it and I don't plan to. But if you have, or if you do, please let us know in the comments what you thought of it. And the reason I recommend Empire Life's is because it has a few different little extra features that I thought were pretty interesting. For one, it auto-populates your life expectancy based on your details, which is kind of cool. But of course, if you want to change that, you can. It also lets you muck around with different inflation rates, and it has a section that asks you questions about your investing style and risk tolerance, since the type of portfolio you have in retirement can make a pretty serious impact on how much you'll have and how long it'll last. Pretty cool features. But one thing I found confusing was the reporting. I used all the same basic assumptions we've been using all along here, but it seems to indicate that at age 90, we'd have nearly the same amount of assets we started out with. I could be reading this wrong, but if I'm not, then it's very far off from all the other estimates I looked at. Very. And I guess that's just one of the dangers of relying on free tools. You just never really can be entirely sure. There's no one that you can really talk to, and with most of them, it doesn't seem to be a way that you can double check the math. Anyway, now we're moving on to how we do it, which obviously we think is the best. And it's the easiest since we do all the heavy lifting. Now, obviously, we're not the only ones that do it like this. So what I'm really referring to here is professional retirement planning. And in our case, we very literally use the best financial planning software in the business. We can try pretty much anything in advance of actually doing it. We can see how it impacts everything else in your life, and we can double check all the math. This software is so ridiculous, it'll even show you your tax returns all the way up to death. And we don't use that feature very often, but the point is, it's miles ahead of other methods. And this is just a part of the package for our clients. I specifically point that out because I know this business very well. And I know that many of you have investment portfolios with a bank or wherever, and you're paying who knows what, and there's a different person that you deal with every time you go in, and you're not getting any serious planning or advice, and yet you are paying for it. This isn't just a sales pitch. This is actually something that you need to know, and many Canadians simply do not know it. I know, because we rescue people from banks and lame firms all day long, and they had no clue what they were supposed to be getting. Anyway, let me show you. And yes, of course, we can do this for couples and pretty much any other scenario you can think of, but to save time, we're just gonna run with all the same assumptions we've already been using. And look, not shockingly, we end up with a base plan that's pretty close to the others we've already looked at. We can see we're tracking at 101% of our goal of $5,000 per month. The key difference here is that complex software like this factors in taxes. So when you say you want $5,000 a month, smart software like this assumes you want $5,000 a month to spend, because no one in their right mind ever says, oh, I think I'd like to have $5,000 a month gross in retirement, and then whatever I have after I pay taxes is cool with me. No, we always speak in after-tax language. So if I say I want $5,000 a month, I want $5,000 a month to spend. And so the software plans for that and accounts for even more coming out of your investments to cover the taxes. None of the other methods we've looked at so far accounted for how much of your income will have to go towards tax. And that's a really important detail, because if you plan to spend $5,000 a month, but $500 of it has to go to taxes, well, then you're going to have to make a decision. You're either going to have to spend less or you're going to run out of money early. Aside from that massive detail, everything else is pretty similar. However, with software like this, we have control over every single detail, from inflation, rate of return, the value of the home, and how much we think it'll grow by, etc., etc. So we can get very granular, and we do. And in this case, we can see that at age 90, we are projected to be almost entirely out of our personal savings. But we will still have a home worth a significant chunk of money. And we may want to see what tapping into that at some point will look like. But for now, we have our bearings, and this is where we can really start to go to the next level with things. This is when we can start strategizing about how to get the most out of what we have and how to make sure we aren't giving more to the government than we need to. Again, we can get pretty detailed with this, but in the interest of time, I'm just going to point out a few of the things that we would typically look at right off of the bat so that you can get the general idea. First thing we would typically do is make sure the income strategy actually makes sense for you. Are you really going to need the same amount of income throughout your whole retirement? Or do you expect you will have phases like we discussed earlier? And if so, should we consider planning for different amounts for those different phases? In this case, we're just going to do that. We're going to keep the $5,000 per month in the go-go phase of retirement until age 75, when we plan to slow things down a bit. And then we'll drop it a bit more from age 85 until life expectancy, since we expect to spend even less during this phase. But remember, even if we were to end up with significant health or long-term care expenses in these final years, we've set aside the house as a backup asset in this plan, so we don't need to worry about that. So just from making that one important adjustment, we've taken the plan from 101% on track to 118% on track. Massive difference. And if we check out our net worth chart, we can see that there is now a lot left in our investments at this point. Over 450 grand more. This changes the game dramatically because now we have a bunch of options. We can retire earlier. We can retire with the smaller portfolio, which means we won't have to save or invest as much. Or we can spend more in the go-go phase of retirement, which is when we'll likely want to do a lot more traveling, etc. And of course, we can try each one of these options and just see what they look like. For the sake of time, let's just look at retiring earlier. We can move this slider and adjust the age to wherever we want, but we can see in this case that we could retire 1 year earlier and we would still be tracking at 111% of our goal, which is sweet. So for the fun of it, let's just keep that as part of this plan. And let's just see what it looks like if we choose to delay CPP. If we were to hold off until age 70, we would get an increased benefit for the rest of our lives, and we can see that it would actually take our plan from 111% solved to 113%. But maybe you want to take it a little bit earlier. No problem. We can move the slider and adjust the starting age to whenever we want, and we immediately see the impact. So cool. But let's just leave it at age 68 and move on. Now let's just say that since you're going to retire 1 year earlier, you now think that you'll probably want to do a bit of part-time work for a couple of years and just make an easy $1,000 a month. And so we plug it in. And there you have it. That throws you ahead another 2% of your goal. This just scratches the surface. We haven't looked at downsizing your home and how that would impact everything, or what it would look like if we took out your investments in a tax-efficient manner. But already, with just trying out a few things, we've taken the plan from being 101% on track to 115% on track, which creates a gorgeous safety buffer. And we've added a ton to the value of the estate as well, all while retiring 1 year earlier. Now, I've done a bunch of other videos on the features of what we can do with this software, so I don't want to beat it with the stick here. The point is, the way we do it is dramatically helpful, not in just making sure that you maximize your situation, but also in making sure that you have crazy peace of mind because you're now able to see the impact of any of the decisions that you're considering well in advance of actually making them. It's a huge deal. And yes, there can be a cost associated with getting this kind of planning done, but the amount you can save by doing things properly so far outweighs it that the two don't even compare. The reality is the vast majority of our clients have their investment portfolios managed through us, and so this is just part of the package. They don't actually pay us anything additional for this. They just have it on tap, and we just keep tightening it as their situation evolves. And honestly, if you have a financial advisor that you're paying, this should just be part of the package automatically. Bottom line is this: estimating can do the trick, but you can do way better, easily, and in most cases, for less than what you're paying right now.